Welcome back to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business. We're going to talk about cash flows today. Here's what we're going to cover. We're going to look at the structure of the cash flow statement, and then we're going to look at how to interpret it. So the structure, first of all. Cash flow statements are organized into three parts. You can see here, this is a classic format for a cash flow statement. We have the operating activities section, investing activities section, and financing activities section. Each of these is about the different sources and uses of cash in the company. The operating activities, of course, have to do with the day-to-day operations of the company. Investing activities have to do with what the company does with respect to its assets. It's not about people investing in this company, it's about this company investing in assets or de-investing, because you could have cash flows that are positive where the company has sold some of its assets. And then you've got the financing activities. This is where everything to do with borrowing and issuing shares is located. Now, the basic format of the cash flow statement is to show positive numbers as cash coming into the company and negative numbers as cash going out. So that's what you're seeing here. The other thing to note about the cash flow statement is that this line here, cash and cash equivalents at the beginning of the year, sometimes that is actually shown right down at the bottom here, somewhere in the subtotal section. So you would start with the operating activities, show the investing activities, then the financing activities, and then you would have a little section of calculations there that shows what the net impact was added to the beginning balance, giving you the closing balance at the end of the year. So that first line, cash and cash equivalents at the beginning of the year, could be at the top of the report or down towards the bottom. The thing to realize about the cash flow statement is that it's basically rearranging everything that's on the other statements, the balance sheet and the income statement. So the operating cash flows section is where you take the income statement and with some adjustments, convert the accrual numbers that are there on the income statement into cash numbers. The other thing that's taken into account is any changes in the current assets and liabilities, because these are considered the operating assets of the company. Current assets and liabilities are often referred to as working capital. They're different from the long-term investments in the long-term financing structures of the company. The investing section is pretty much restating the fixed assets section of the balance sheet and showing the cash implications of any changes there. On the balance sheet, of course, you'd expect the fixed assets to go down in value from one year to another because of amortization or depreciation, but those aren't cash events. So the investing section of the cash flow section is showing actual changes in cash as cash is used to purchase an asset or cash is released by selling an asset. The financing section then is where you have all the changes to do with liabilities and equity. You're talking here about borrowing from the bank for long-term debt or repaying the bank. You're also talking about issuing shares or repurchasing shares. And the interesting thing here to keep in mind is that dividends go into this section. So if the company pays dividends, that's considered a financing cash flow. For a lot of companies, when they create their cash flow statement, the interest on long-term debt is not put in here. Interest on long-term debt is often considered an operating cash flow. And the only thing that you would show in the financing section would be changes in principal, either a loan being issued to the company or the principal being repaid on the loan. So that's how the balance sheet and the income statement relate to the cash flow statement. Let's take a closer look at the cash from operations, or the operating cash flow section, as it's also called. There are two kinds of approaches to this, and they're quite distinct, but they both end up with exactly the same number. Now, the indirect method is an attempt to help people understand the difference between the accrual income that's stated on the income statement and the cash transactions that arose from operating activities. The indirect method starts with net income, and then it adjusts that net income number to cancel out any pure accrual entries that were made onto the income statement. So depreciation on fixed assets or amortization of fixed assets, that was a deduction from net income, but it had to do nothing with cash. So if you add those back, then you're basically moving from the net income number closer to the cash flows from operations. The same thing if the company disposed of assets and recorded a gain or loss, exactly the same thing. You want to undo those to move from the accrual number back towards cash from operations. Then the second thing that has to happen here is that you need to deal with any changes in the non-cash working capital. So working capital is current assets and current liabilities, but you have to take the cash out of that section of the current assets because we're trying to explain cash here. So we don't want to include the change in cash in the working capital section of the indirect method. So all we're trying to do is show what were the changes in accounts receivable, inventory, prepaid expenses, those kinds of assets, and what were the changes in current liabilities like accounts payable. The thing that you have to look at here is that these are actually looking at changes from one year to the next, and you can often calculate these yourself by looking at the appropriate section of the balance sheet. So just keep in mind that if accounts receivable was high last year and has gone down this year, that means the company collected money from its customers. So that should show up as a positive number for the change in accounts receivable. Same thing with inventory. If inventory was low last year and is higher this year, that would indicate that the company used money to purchase more inventory. Same with prepaid expenses. If they've gone up, the company has used money. If they've gone down, it means the company has actually taken advantage of the fact that it prepaid those expenses. And it means that the expense that's shown on the income statement for that wasn't actually a cash expense. So we need to take that into account. With accounts payable over on the liability side, under current liabilities, if that goes down from one year to the next, it means that the company paid its supplier. So that would be a use of cash. And you'd expect to see a negative number on the cash flow statement to indicate that. Here's an example of the indirect method. It starts with the net income number up here. And you'll see that in the previous year, it was a negative number. They lost money. This year, it's a positive net income. So last year's loss of, I presume this is in thousands, so $5,157,000 got turned around this year by a net income, a positive number of 894,000. Working from this number, then what you need to do is adjust it for the non-cash items. So you have amortization, interest accrual, gain on sale of property, future income taxes, stock-based compensation, lease inducements, all of those things are expenses or changes on the income statement that actually didn't involve cash. So whatever you saw there on the income statement has to be reversed in order to convert the net income number to cash from operations. Then the last thing that you see here is just this one summary line here, which is the change in non-cash working capital components from operations. Lots of companies summarize that onto a single line here, and then the details of that would be provided in a schedule in the notes. So you would want to turn to those notes and look to see where those numbers came from. So change in non-cash working capital for this company was positive in both years. And that would mean that they were drawing money out of their working capital. And you have to look at why that was happening. If you saw a number was negative, it could be, for instance, that they'd purchased a lot of inventory that year. So that is something to investigate by looking at the notes. And what you end up with at the end then is the cash provided by, or if it's negative, applied to operating activities. So this is the indirect method. The direct method is much easier to understand because it simply lists what were all the inflows and outflows by various categories. Customers, how much money came in from customers. Suppliers, how much money was paid to the suppliers that year. How much money was paid to the employees in wages and other compensation. Did the company receive interest on its investments or did it pay interest on its bank loan? And what happened with taxes? And this is an interesting line here because you can actually see what was the actual cash transaction with the government over taxes. Lots and lots of companies have tax expenses shown on the income statement that are completely unrelated to the actual amount of cash that was paid to the government. And in some cases, you could have a tax expense shown, but the company actually got cash back from the government that year. So it's a very important number to look at if you're trying to understand the company's tax situation. Here's an example of the direct method from a company called Stantec. And you can see that it has broken out the various cash receipts, cash paid, so forth, interest received. You'll notice here that it breaks the interest number into two things, how much was received and how much was paid, rather than netting those out. So that's good information. The same thing with income tax. They're showing how much income tax came in and how much was recovered. And that can happen if you're operating in different countries, right? You may end up paying cash for income taxes in one country, but getting a recovery in another. So that's why they're shown on separate lines there. Finance costs paid would be probably underwriting fees. These are negative numbers right here. That would be cash going out to pay for finance. And then the total, of course, at the bottom is the cash flows from operating activities. Stantec is raising a lot of cash from its operating activities. Looks very healthy. The investing activities, or the cash from investing activities section, is where you will see the purchase and sale of assets other than the working capital current assets. If a company buys a new factory or vehicles, you'll see negative cash outflows there. If they sold vehicles or sold some of the fixed assets, you'd see positive cash flows there. Some critical questions that you can begin to ask about this section is the company investing in productive assets, or are they investing in financial securities as they're parking their excess cash, as we've seen with Apple? The other question, of course, would be if they are investing in productive assets, are they investing enough? And that's a qualitative question that requires some interpretation. You can't simply calculate that. Another possibility is that a company is retiring some of its older assets. That could be a very healthy, bold strategic move by the managers, or it could be a desperation ploy to drum up some cash in a crisis, and perhaps they're selling an asset that they really shouldn't, but they have to in order to survive. So these are all the kinds of questions that you should be asking yourself when you look at the investing activities section of the cash flow statement. Finally, there's the financing activities, and here's where we have the borrowing and repayment of debt and the sale and repurchase of shares and payment of dividends. So this is going to be different than the dividends declared in the change of equity statements. This is the actual cash that would have been paid out during the year as dividends, not simply the dividends that were declared. So what are some questions you can ask about this? Well, if the company is borrowing money, why do you think it is? Does it make sense for them to be borrowing money given their strategy and their opportunities? We saw with Apple, it was kind of weird that they were borrowing money when they had so much cash lying around and so much positive cash coming in from operations. Why were they borrowing? And if they are borrowing money, is it from the bank or is it from the market by issuing bonds and so forth? Because those might indicate different situations where, for instance, the bank might have a lien on a factory if the bank is providing the financing. So that would change your understanding of the debt structure of the company. You'll also see positive and negative cash flows coming together in this section because they may be refinancing their debt, replacing an old bank loan with a new one at a better interest rate. So that's something to look at. If the company is paying off its debt, you want to ask where it got the money. So you would look at the other sections of the cash flow statement. Or it might be that they have paid off their debt by issuing shares, which would be right in this section of the cash flow statement. If the company is issuing new shares, is this a substantial amount of shares that are being issued by going to the stock market for additional financing? Or is it just a small amount that is being paid out to executives as part of their compensation package? So you want to look at who is actually getting those shares. That's not going to be stated on the cash flow statement, but you can investigate that further by looking at the notes to the financial statements and the MD&A section of the annual report. And if the company's buying back shares, why are they doing that? Who benefits from the fact that they're buying back shares? Is this an effort to consolidate the power of the managers who are sometimes major shareholders? And whose money is it that they're using to buy back the shares? How are the other shareholders left off after the buyback? Do they own more of the company? And is that something that they're happy with? Is this part of a strategy to consolidate their power? All these questions are interesting. If the company's paying dividends, you want to ask if it can afford to. It may be that it's trying to pay dividends that it committed to, and it might be actually in a bit of a financial strait this year, but it doesn't want to cancel its dividends because that's politically costly. Again, another critical question to ask. Now let's look at how we go about interpreting the cash flow statement. Obviously, we've asked a lot of critical questions there. I just want to give you a tool for looking at the cash flow statement, the overall patterns of it that will help you get at some of the implied meanings that are in the cash flow statement. Critical questions always have to be asked about the cash flow statement. When you're looking at the overall patterns here, you want to ask if the business is generating enough cash to meet its operational requirements. If it's got opportunities to expand, does it have enough cash to do so? Is it able to cover its short-term debts? Is it paying off its long-term debt appropriately, or is it making huge repayments to retire its debt? And if so, why? Is it paying dividends? One critical question to look at here is there an opportunity there for the managers to have influenced the timing of the cash flows? Because that would be something that they would have significant control over. And you want to ask not just what are the cash flows, but why are those cash flows happening this year in particular? And that will relate to financing, strategic questions, political questions, and so forth. So something to look at, something to ask. A crucial question is to try and link all of these things back to the corporate strategy. And for that, you need to really understand the company. As with all financial statement interpretation, you really have to understand what the company is and what it's trying to do in order to interpret its financial statements. All right. So now we get to have a little detailed look at the patterns that are possible on the cash flow statement. And for this, I'm heavily indebted to the article that's listed at the bottom there. Really interesting article for people who are teaching the cash flow statement. And I'm going to use it here pretty much as they laid it out in that article. The basic idea here is that you have three different sections and eight different combinations of positive and negative cash flows that are possible because of that. Now, obviously, any given section of the cash flow statement could be at or near zero. So in those situations, it's not an easy explanation to make. But here we have the broad brushstrokes patterns that you might observe on a given cash flow statement and a tentative explanation for the kind of company where that pattern might hold true. So let's look at one of these. The first is if you have positive cash flows in every section. So the operating section is generating good cash flows. They're also producing cash by selling off some of their assets. And you'd have to ask what kind of assets they're selling. And then they're also producing cash through financing, either by borrowing or issuing new shares. So, what might be happening here? Dugan et al. Suggests that the company is highly liquid, is generating lots of cash, and is possibly trying to loosen up some cash in order to make an acquisition in the future. Now, this isn't the only possible explanation, but that's a really interesting one, right? Otherwise, why would you be selling off assets and borrowing money from financing or issuing shares at a time when your operations are healthy? Could be that you've got a really great opportunity that you need to purchase in the near future. Second pattern would be where you've got positive cash flows from operations, but negative cash flows in the investing and financing activities. Company generating strong cash from operations, and it's using it to invest in new assets, right? So the cash is being generated by operations and it's going into purchasing new assets. At the same time, they could be paying off debts or paying dividends to the owners. So that's a pretty healthy situation for a company to be in general. If you got positive cash from operations and investing activities and negative cash from financing, it could be that the owners are drawing money out of the company. They're being paid dividends in order to use the cash for other purposes unrelated to this company. It's a curious sort of pattern. So you're generating healthy cash flows from operations. You're also selling off some assets and you're returning money either to the bank or the debt market or to the owners in some way. So you have to look a little more closely at the financing section to understand that. Fourth pattern, positive cash flows from operations, but also positive cash flows from financing, negative cash flows in investing. So the company is healthy, it's generating operating cash flows, but it's also generating cash through financing, debt, or issuing shares in order to fund the investment in new assets. So the question is this an expansion that they're doing, or are they just replacing some of their obsolete equipment? Fifth scenario, negative cash flows from operations, but positive cash flows from investing and financing. They could be trying to cope with their operating cash flow problems by selling off their assets or borrowing from the bank. So that's a potential warning sign. Does not mean that all companies with this pattern are in trouble, but it's something to look into. Here's a situation where you've got negative cash flows from operations, negative cash flows in investing, positive cash flows from financing. Classic situation here would be a company that is just starting up. They're raising capital and they're investing in new assets, but their operations are not yet generating a profit or even positive cash flows. This is the opposite situation. You've got negative cash flows from operations, but it's not because the company is new. It's because the company is old. They could be winding down their operations. Like I say, it's a mining company and their mine is being retired. So you are selling off some of your assets and returning money to the shareholders or paying off any bank loans that you've got. Finally, negative cash flows in every section of the cash flow statement. Not a great situation, obviously. Cash is leaving the company. You could be using your cash reserves in order to cover shortfalls if you're having to use your cash reserves in order to pay off debt or something like that. This is not necessarily a crisis. It could be some sort of a change in strategy as the company repositions itself, but obviously not a sustainable situation for the company. Let's sum up what we've learned about the cash flow statement. We have covered the structure of the cash flow statement, looking at the direct and indirect methods of the operating cash flow section. We've looked at the investing and financing sections as well. And then we've gone through a series of critical questions and patterns to interpret in the cash flow statement.
Well, it's all about money, money, money. Ooh.